Welcome to the video. If you clicked on this video, it's because you want to see the strategy that I use to make $10,000 on this GBP JPY position. So let's get straight into that. So first of all, what did I see here in the market that even wanted to make me want to look for buys? So that's very simple. Okay. The first thing that I like to do when I'm establishing the trend of the market is just simply see where the past couple of days of price action has gone. So if we look at the daily time frame, we'll take a look here. In my case, when I was analyzing this market for the first time and starting to look for positions, we were here inside of this consolidation area. And I see that in the past couple of days, and even if we look at the weekly time frame, the past weekly candle was a massive candle to the downside. So that means that this market at one point in time was a very bearish market with a strong trend to the downside. That of course changed right here. This is where the market shifted from one of the first cycles that it went through, which was the bearish trend, to then a consolidation cycle. So the market moves in these types of cycles, and it can only be bullish, consolidating, or bearish at once. But it has to be one of those three, and it can only be one of those at once. So it went from a clear bearish cycle to a cycle of consolidation. That's very simple, and it's also very obvious when we look here on the daily time frame. Now, hopefully now when we go on the 4-hour, you can still see how obvious it is that we are in a consolidation. Because yes, even though price did attempt to break lower and continue to go down, it immediately came right back up with a massive bullish candle. But that does not mean that the market was bullish, because if it was bullish, it would have formed a higher low, which it did, and it would have formed a higher high, which it did not. It was essential for this higher high to be formed in order for this to start transitioning into a bullish market. But because it didn't happen, it means we are not bullish. Instead, we entered in a consolidation area. So let me remove these drawings and I'll show you more clearly where we were in the market. As I'm starting to analyze this market, I notice that price continues to reject right off of a specific price. In specific, the price is 189.400, give or take 10 or 20 pips. So if price is rejecting off of that area over and over and over again, it means that that is holding as a resistance. It's very simple. If we have a strong resistance area across this horizontal price level, then we simply need price to start trading above there in order for us to start looking for buys, and in order for us to even say, okay, I think I see a trending market. And for context, I personally only trade with my strategy Ride the Wave. I only trade trending markets. I avoid taking a trade in a consolidation market. I only trade when there is a clear and established direction, because that's what maximizes my win rate, and that's what removes decision fatigue when entering a position, because that way I don't have to think about what direction to enter in on. I can only enter in on the direction of the overall trend. That increases my win rate, reduces hesitation when looking for an entry, and makes my trades way higher risk to reward and just a higher quality overall. The reason why it's a higher risk to reward is because we're going to enter in on a higher low point. When we're buying, the market structure is bullish and it continues to form higher lows and higher highs. We're going to always try to enter in at a higher low point. And the way that we're able to establish or to know which is actually the higher low, instead of getting confused and then getting stopped out, is simply by being in alignment with the market and knowing the moves that it's making. What I mean by this, let's get very specific here. Let's zoom in to this price point right here. We can clearly establish that this is a low, this is a high, and this is a higher low, this is a higher high, and this is a higher low. Because I saw that happening live, I knew that this is where I wanted to enter. The second that we broke and closed above with a 4-hour candlestick above this major area of resistance that price was unable to break for such a long time, I wanted to be in this trade. At that point, my only thing left to do was to find the higher low to enter in. I enter in off a higher low so I can get a better risk to reward. I can place my stop loss near the low of the previous higher low, and the take profit is going to be at the next major area of resistance, or if there is no major area of resistance, like in this case, instead what I'll do is I'll simply just place it where I believe the next higher high is going to be. Because if we're in a bullish market, It's very simple. We're going to make higher lows, which we're entering in off of, but then we're going to make a high higher than the previous higher high. So hopefully you guys are following along. I know it sounds a little bit complicated, but it's very, very simple. All we're simply doing is waiting for the market to just go up to the next level and we get out at that next level. That's it. We're not looking for it to continue and continue and continue and continue bullish, because I found that messes up the win rate a lot. We're just looking for this one direct movement straight into our take profit, not for it to continue to make higher lows and higher highs. It may do that, and it does do that a lot of times. And a lot of my trades, you could have potentially held it to like a 1 to 10 risk to reward, but that's not what we're going to be doing here. In this strategy in specific, we're only going to be looking for that one direct movement. And that's exactly what I caught here that allowed me to make the $10,000 profit on GBP JPY. If I haven't drawn up the screenshot, then I'm going to throw it up now on the screen so you guys can see my exit price. I exited around somewhere around here at the top. So really, really precise exit point right there, because I was already satisfied with my profit and the market had made that higher high that I had predicted. Now, there is one major key point that I have not talked about yet, and that is, of course, where did I enter this trade and where should you look to find your trade entries? It's probably one of the most important parts, and that's what we're going to talk about right now. So I definitely saved the best for last. We're going to go down into the 1 hour time frame for this entry. So just to recap, we analyzed this on the weekly, the daily, and the 4 hour time frame. The weekly and the daily for direction, the 4 hour from the market structure, and the market, the structure points in specific. And now we're going down into the 1 hour time frame for our entry. Now, I like to enter in trades a couple of ways. One of the ways is with an engulfing candlestick pattern. That's a very high probability entry confirmation. However, you won't always be able to wait for the candlestick to happen, because if you do, you'll either miss the trade or your risk to reward goes down. In this case in specific, I did not use the engulfing candlestick pattern entry. Instead, it's very simple. I was watching the market around 11 p.m. Wednesday night, and what I saw was that the market started to reject. In specific, I saw this rejection candlestick right here, this small bullish candle. I'm going to zoom in even more. So when I saw this first candle, this is a 1 hour candle. Very simple. Off of the area of support. So because it was off of the area of support and price really tried to go down there, I knew, okay, I want to be in this trade. I want to be in this trade ASAP. Then I saw a couple more candles form and essentially, I entered in off of here. So the actual entry was more to the left. I only saw like one more candle form. This is on the 1 hour time frame. Entered in around 11:30 p.m. at night, because what I did was that I set a buy limit around 10 pips below this candle right here, or below 10 pips of where we were in that moment, because I knew it was going to try to come down more before shooting up. Technically, that's kind of risky because the market could have gone up without triggering me in my buy limit, but 99% of the time it is going to trigger my buy limit and it's going to do something like this. Thankfully, we had basically no drawdown on this trade and the market went straight bullish over the course of the next day and a half. I exited this trade out at Friday in the New York session. Beautiful, beautiful time to exit out of this trade, and they called it a day. This trade was a 1 to 2 risk to reward, but in reality, once price started going slightly in profit, I moved my stop loss up, therefore essentially making it like a 1 to 3. And there's no way I probably would have let the market come all the way down to my stop loss. So I'm going to consider this to be closer to a 1 to 3 risk to reward ratio. But worst case, if you really want to consider it based off of what you see on the screen here, it was a 1 to 2 risk to reward ratio. Just keep in mind I initially had a larger take profit, but because it was Friday and because I was satisfied with my profits, I decided to exit out there. That's the strategy. Let me know what else you guys want to see in the comments below. And let me know if any part of this strategy was unclear to you so I can make a follow-up video clearing it all up. So appreciate you guys for watching this. Make sure to watch this next video on the screen here and appreciate it. Drop a like, drop a comment, subscribe, and I'll see you guys.